Have you noticed the growing buzz about a recession lately? Well, it's no longer just a possibility whispered in financial circles. Top CEOs, economists, even the bond market are starting to sound the alarm that the US economy may already be in a recession. Let's break it down. According to recent comments made by major corporate leaders, most notably at a high-profile event in New York, many CEOs believe we're already in a recession. Take the airline industry, for example. Often seen as a canary in the coal mine, several airlines have reported a sharp downturn in demand since February. One CEO even described it as a parade of horribles. And it doesn't stop there. Wall Street firms like Goldman Sachs have now increased their recession probability to 45% and slashed their GDP forecast to just 0.5% for the year. That level of GDP growth, it's solidly in recession territory. Why is this happening? One major reason is the consumer economy, which for years was seen as resilient. But that resilience might finally be breaking. Consumer credit is falling. Yes, actually declining for the first time in a while. That's a red flag. Lenders are pulling back, borrowers are tapped out, and people are not swiping their credit cards like they used to. This isn't just about spending. It reflects deeper stress in employment, wages, and confidence. Even consumer sentiment is slipping. Let's look at TIPS, Treasury Inflation-Protected Securities. These are government bonds that adjust for inflation. If investors expect high inflation, demand for TIPS goes up. But guess what? Inflation expectations are crashing, especially in long-term metrics like the five-year forward inflation rate, which just dropped to levels not seen since early 2022. And before that, the disinflationary periods of the 2010s. Translation? The market believes we're not facing long-term inflation, but instead sliding into a period of economic weakness or deflation. In fact, the TIPS market is inverted, with short-term inflation expectations higher than long-term ones. That's a clear sign the market expects any price spikes, like from tariffs or energy costs, to be temporary, followed by weaker demand and economic slowdown. This is the opposite of what we'd expect in a strong, inflationary economy. Now, while some officials argue that inflation may rise again, the bond market and now Wall Street are pricing in rate cuts. Some forecasts suggest the Fed could cut rates by 130 to 200 basis points this year if recessionary conditions worsen. This isn't about fighting inflation anymore. It's about stimulating a slowing economy. Markets are reacting accordingly, with rising volatility, margin calls, and asset liquidations across stocks and commodities. So where are we now? The data, the markets, and even the insiders are aligning on one uncomfortable conclusion. This isn't just a recession probability anymore. It might be the real thing. And if that's true, we can expect continued turbulence across the stock market, credit markets, and consumer economy. Add in global factors, rising debt, and even an overheated AI sector, and you have the ingredients for what could become a deep and painful downturn. Understanding these warning signs isn't about fear, it's about preparation. When credit tightens, inflation cools, and markets wobble, it's not random. It's a signal that smart investors, analysts, and everyday people should learn to read. So what do you think? Are we already in a recession? Or is the worst yet to come? Let me know in the comments, and don't forget to subscribe for more breakdowns like this.